Stop whatever you are doing right now and pay attention, because what I am about to walk you through is something the mainstream financial media has either completely missed or deliberately chosen to ignore. The Silver Institute just released the World Silver Survey 2026, an 88-page document researched and produced by Metals Focus, a London-based independent precious metals consultancy that interviews miners, refiners, bullion dealers, and bankers across the globe every single year to build the most authoritative picture of the silver market that exists. These are not newsletter writers. They are not internet commentators. They are the people the silver industry itself relies on to understand what is actually happening. And what they have just confirmed is this: the era of unlimited silver liquidity is over. Let that land for a moment before we go any further. Today, April 16th, 2026, silver is trading at $80.33 per ounce. That is up 1.74% on the day. It touched an all-time nominal high of $121.67 on January 29th of this year before pulling back, and it is now trading in the low 80s as investors weigh the ongoing U.S.-Iran ceasefire situation, a weaker dollar, and what the Federal Reserve does next. Gold is sitting near $4,735 per ounce. The gold-to-silver ratio is around 61, which historically speaking still places silver in undervalued territory relative to gold. But the price alone is not the story. The structure underneath the price is the story, and that is exactly what this survey documents in a way no other annual report does. Here is the foundational number you need to understand everything else. The silver market ran a supply deficit in 2025 for the fifth consecutive year. That means the world consumed more silver than it produced. Again. The cumulative deficit across those 5 years, from 2021 through 2025, now stands at over 762 million ounces. That is not metal sitting in a warehouse somewhere. That is metal that went into solar panels on rooftops, into circuit boards that end up in landfills, into EV batteries, into the AI server infrastructure running every large language model deployed since 2022. Once silver goes into those applications, no price signal on any exchange brings it back. It is permanently consumed. And for 2026, the survey forecasts a sixth consecutive deficit, not smaller than 2025, but larger, projected at 46.3 million ounces. If that forecast proves correct, the cumulative 6-year shortfall will exceed 800 million ounces, which is more than 3 times what the entire COMEX registered vault held at its 2020 peak. The survey also goes into significant detail about what happened in the London market in October 2025. And this is the part that most mainstream coverage has completely glossed over. By the end of September 2025, physically backed exchange-traded products accounted for 83% of total London vault inventories. The free float, meaning the silver actually available for day-to-day market operations, lending, and leasing, had fallen to an estimated 136 million ounces. Now here is why that number is alarming. The LBMA's average daily spot trading volume in 2025 was approximately 450 million ounces. The entire available free float was less than 1/3 of a single average trading day's volume. When strong physical demand arrived from India in October, the market had zero buffer. The squeeze that followed was not a surprise to anyone paying attention. It was the inevitable outcome of years of structural deficit finally colliding with a moment of acute demand at precisely the time when the liquidity cushion had nearly disappeared. Lease rates, the cost to borrow silver temporarily, hit 40% annualized. The survey confirms it. A market that had felt well supplied just 12 months earlier had become one where sourcing physical metal felt almost impossible. Now let us talk about COMEX, because the survey's inventory data connects directly to what is happening in the futures market right now. Global identifiable silver bullion inventories at the end of 2025 were approximately 1.39 billion ounces across all major exchanges, including London, CME, Shanghai, and others. The CME's share was approximately 449 million ounces, up 41% from 318 million ounces at the end of 2024. That increase came from tariff-driven inflows, bullion banks moving silver into U.S. vaults early in the year to hedge against potential import taxes. Those inflows have been reversing since October 2025. Roughly 201 million ounces have left the combined COMEX system since the peak. The registered vault, the pool of metal that actually backs futures delivery, currently sits near 124 million ounces. Paper leverage against that pool is running at 7.5 to 1, meaning for every single ounce of deliverable registered silver, there are 7.5 ounces of paper claims sitting on top of it. May 1st is First Notice Day, just 15 days away, and whatever delivery demand materializes must be absorbed by that registered pool. On the solar and industrial side, there is a narrative circulating that AI-driven thrifting is solving the silver scarcity problem. That because manufacturers are engineering silver out of solar cells, the structural deficit will resolve itself. The survey addresses this directly, and the conclusion is not what that narrative would suggest. Yes, photovoltaic silver demand declined in 2025. Thrifting is real. But thrifting is happening against a backdrop of explosive solar capacity additions. China alone added 275 gigawatts of solar capacity in just 11 months of 2025, exceeding the entirety of 2024. The per-unit savings from using less silver per cell are being overwhelmed by the sheer volume of cells being manufactured. Total silver consumption from solar remains enormous. The math does not support the idea that thrifting will close the structural gap anytime soon. Mine supply tells a similar story. Global mined silver production in 2025 was 846 million ounces. The 2026 forecast is 844 million ounces, essentially flat. Mexico, the world's largest silver-producing country, saw output fall for the third straight year to its lowest level in a decade. Opening new mines or expanding existing operations takes years, not months. Environmental approvals, feasibility studies, capital allocation, infrastructure, none of that happens in response to a short-term price spike. The idea that higher prices will quickly unlock a surge in mine supply is simply not supported by the data the survey presents. On the investment side, the survey documents something worth understanding clearly. Coin and bar demand, direct retail investment in physical silver, came in at 217 million ounces in 2025, up 14% from the year before. That increase happened despite silver's annual average price rising 42% year over year to $40.03 per ounce. Higher prices did not suppress retail demand. They intensified it. Global silver ETP holdings reached a fresh record high of 1.3 billion ounces by the end of 2025. Philip Newman, managing director at Metals Focus, noted that ETF inflows have reached 187 million ounces so far this year, driven by investor concern over stagflation, Federal Reserve independence, government debt sustainability, the dollar's reserve currency status, and geopolitical risk. Silver is being accumulated at record levels inside a market that is already structurally short of supply. That metal sitting in ETPs is not available for industrial use. It is not available for leasing. It is locked. And the more of it that gets locked, the thinner the free float becomes. So here is where everything stands as of today. Silver is at 80.33. The Silver Institute and Metals Focus have just published the most comprehensive annual review of the global silver market and confirmed 5 straight years of structural deficit, a 6th on the way that is projected to be larger than the 5th, mine supply going nowhere, free float in London that came dangerously close to critical levels last October, ETP holdings at an all-time record, retail investment demand rising despite higher prices, and paper leverage on COMEX registered inventory at 7.5 to 1, with first notice day 15 days out. The survey does not use dramatic language. It uses institutional, precise, carefully measured language. And even in that language, the conclusion it reaches is unambiguous. The structural conditions that define the silver market for the past 5 years have not resolved. They have deepened. The World Silver Survey 2026 is publicly available at silverinstitute.org. Read the actual document. The data is all there.